Hi everyone and welcome. Thanks so much for joining us. My name's Michaela McKenzie and I'm the Chief Operating Officer at Master Grocers. Today's webinar we're focusing on salary compliance in retail, an area we know can be really challenging for a lot of retailers. I'm joined by our HR Advisory Manager, Robbi Kearins, who will be taking you through how underpayments can occur even with a salary, what records you need to stay protected, and then practical steps to reduce your risk. Just a couple of quick housekeeping points before we begin. This session is being recorded and we'll share the recording with you after the webinar. Please note that the information provided today is general in nature. If you're an MGA member, you can contact our advisory team at any time for support with your specific situation. As a member, you also have access to a wide range of templates, policies, contracts, checklists, and other practical tools via our advisory team or via the online member portal. If you have any questions during the session, please submit them via the Q&A tab at the bottom of your screen. Robbi will address these at the end of the presentation. If we do run out of time to respond to your questions during the session, we'll reach out to you directly about that question that you had over the coming days, and we'll discuss it further with you in detail. Thanks again for taking the time to be with us today. And without further ado, I'll hand over to Robbi. Thanks.
Thanks, Michaela. Hi, everyone. And as Michaela said, I'm Robbi. I'm the HR Advisory Manager. You may have spoken to me or my colleague, Elsa, if you've called in for a query. Today's webinar, we want to have a look at salary compliance if an employer wants to pay an employee using an annualised salary arrangement and the roles covered by the General Retail Industry Award, the GRIA. All right, it's not unusual when I'm chatting with a member about a query that a comment is made that the employee is salaried. Now, my squirreled thoughts want to go running after that little chestnut with questions like, what do you mean salaried? Do you mean they're not covered by an award? What hours do they work? Do they have the same hours every week or every fortnight? Do you mean they're paid above award so you don't pay them separate overtime or penalty rates? Have you got an employment contract? What classification are they? Now, you called and asked whether you need to pay them separately for a public holiday. Meanwhile, I'm about to open a whole other can of worms. What I'm trying to say is there's a lot to talk about. So the intention today is really just to highlight the common areas of confusion and clarify them enough to let you know whether to give us a call to talk more. We'll look at some obligations under the GRIA. I'll go through a quick payroll example to show how easily an underpayment can happen. And we'll sum up with some compliance tips. So last year, a federal court decision brought by the Fair Work Ombudsman against Coles and Woolworths highlighted how annualised salary arrangements are to be applied and interpreted. This case raised a key point concern for many employers, and in our industry, it started conversations for those who pay employees with an annualised salary. So they're taking what they anticipate an employee earns throughout the year, and they're paying it in equal instalments each pay period. The court decision was that an annualised salary only counts towards award entitlements in the same pay period that the entitlement was earned. The pay cannot be averaged annually, even if the employment contract has an offset clause. Now, the specific clauses in the GRIA that outline conditions on employee wage payments include Clause 18.1 that allows employers to determine the length of a pay period as either a weekly or fortnightly period, and Clause 18.2 that states wages must be paid for a pay period according to the number of hours worked by the employee in the period or averaged over a fortnight. That's it. Some awards have specific provisions that address annualised arrangements, but not the GRIA. While Clause 15.6 allows for an employee to work an average of 38 hours a week over various periods, including up to 4 consecutive weeks, there's no link to any other clause that would allow the averaging of pay over these extended periods. So again, even if your intentions are to provide a consistent income for the employee, the award says no. And actually, the federal court decision says no. What about offset clauses? If you've spoken with our team about annualised salary arrangements, you may have heard us refer to an offset clause. So what does an offset clause allow? Does it allow a different interpretation? Nope. An offset clause allows a higher base rate to offset the need to separately pay things like overtime or penalty rates or allowances. But the employees must still receive no less than their minimum award entitlements in each individual pay cycle. Even if your contract says this salary compensates you for everything, and you mean over the year, that won't protect you. Again, employers must ensure employees receive no less than the minimum award entitlements in each individual pay cycle. You cannot offset over or underpayments across a longer period, and offset clauses don't allow pays to be averaged over a year, regardless of what the employment contract states. So why do we need to be vigilant? One underpayment equals non-compliance, even if over the year the employee is better off. And on top of that, since January 2025, intentional underpayment can be a criminal offence, so the stakes are significantly higher than they used to be. Even in a relatively simple roster pattern, an annualised salary may leave the employee and ultimately the business short. Let's bring it to life with a simple example. We've got a shop manager, they're level 8 under the award. The minimum award annual rate for this employee is approximately $65,000. The store employs this person on an annual salary of, let's say, $90,000. Their contract wants to include in this up to 45 hours per week. They're going to work alternate public holidays. They're going to work alternate Saturdays. Now, on face value, you'd say, looks okay, there's a fairly decent buffer there. But what we need to do is test, does it hold up in a real pay cycle? So here, let's take a week where the employee works a public holiday, they work a Saturday, they work more than 38 hours for the week, so there's some overtime in there as well. If you calculate what this employee is entitled to based on the award, public holiday rates are significantly higher than the standard base rate. Saturday penalties will apply and overtime applies. The total entitlement for that week comes to $1,849. That's the minimum the employee must legally receive for that pay period. Now let's look at what happens under the salaried arrangement. Based on an annual salary of $90,000, they're going to receive an hourly rate of $45.33 for 38 hours per week. That's how it works. So for that week, that employee gets paid $1,722. When we compare the two, there's an underpayment of $127 in just 1 week. That's all it takes. Again, an underpayment of $127.16 in just 1 week, and suddenly we've got a compliance issue. So let's try averaging it over a fortnight. We'll say that you have a fortnightly pay cycle, and we can do that. Again, the maximum pay period, we're meeting that. Week 1, the employee still works the public holiday, they work the Saturday, they work more than 38 hours. Week 2, again, in line with their contract, they work 45 hours. They work Monday to Thursday, 9 hours. There's still overtime involved. There's still all the other penalties from the previous week. So for that fortnight, the employee under the award would receive $3,488. If we're looking at the salaried arrangement, it's 76 hours at that loaded hourly rate. Under the annual arrangement, they'd get $3,444, still left with an underpayment of $44. So again, we can't average it over a year. We can only average it over a pay period. Compliance issue. All right, so then an employer says, well, I'll top up payment for the high weeks. Yep, we can do that. Pay an additional $127 for that short week. Every other week in this example, you'll still be paying an additional amount of $83.76. This is on an ordinary week for this contract. So 45 hours for this week under the award. there's no Saturdays, there's no public holidays. Under the award, they'd be entitled to be paid $1,638. So now you're paying an extra $83 based on the annual rate. But we can't use that overpayment to offset. It still only applies for that one pay period. So what I'm trying to identify here, that even when the salary looks generous and there appears to be a healthy buffer, one penalty heavy week can wipe that out. Or in your average week, there's an extra payment being made. And remember that that higher hourly rate is also payable to the employee on all of their leave entitlements and their superannuation. So what does this all mean in practice? At a minimum, employers must ensure employees are paid at least their award entitlements each pay cycle, not relying on averaging, and actively monitoring whether the salaries are keeping up with the actual hours worked. Record keeping is really important here. You need to be able to show the actual hours worked by the employee, including overtime and penalty and breaks, not just what was rostered. We have to show the actual, because if a claim is made, your defence is going to really rely on you being able to produce accurate time and attendance records. Salary arrangements can still work, but really only in specific situations where the employee is working consistent hours, the work patterns are predictable, and the exposure to penalty rates or changing rosters is low. They become risky where the rosters vary, weekend work is frequent, or public holidays are worked. If you're setting a salary, there's 3 key steps. First, make sure that you've got the correct classification for the work the employee is doing. The work is what determines whether or not an employee is covered by an award. Second, model some real working patterns, not just ideal weeks, but real weeks, including worst case scenarios. And third, build in a buffer. Importantly, that buffer needs to cover penalty heavy weeks, not just average weeks. So let's have a look at the contract requirements. Your employment contract, if you're going to enter into an annualised salary, also needs to support this properly. It needs to clearly state what the salary includes. Does it cover penalties, annual leave loading, overtime? And it has to include it via a properly drafted offset clause. Without this, your annualised salary arrangement may not hold up if challenged. An employee may claim that that was their base rate and they expect to be paid overtime and penalty on top of it. Some practical tips you can take: audit your salary employees regularly, compare actual hours against their award entitlements, adjust where needed. And honestly, before you go into it, if the role looks to be subject to too many variables with their rosters, consider whether a salary arrangement is appropriate at all. So to wrap it up, the key rule is every pay cycle must meet what the employee would have been entitled to under the award. If you're unsure whether your current salary arrangements are compliant, it's really important to review them now. This is an area regulators are actively focusing on. We seem to be getting an increase in underpayment claims, and getting it wrong can be costly. If you need help reviewing salaries or modelling risk, feel free to reach out to our team. We also have a referral partner and they can assist with more extensive payroll reviews where required. That's it. All right, how are we going with questions?
Thanks, Robbi. We do have one question that's come through. If employee changes from salary to wages, can the pay rate be reduced?
No. There's a short answer for you. We're still bound. If an employee has a current contract, we're still bound by the terms of that employment contract.
you. That's the only question we've had come through. If anybody else has any quick questions they want to pop up into the Q&A, we can hang on for a minute. Otherwise, we will be sharing this recording with you in the coming days. Of course, I have also popped up our advisory team phone number. It's 1-800-888-479. So please feel free to call through to the advisory team at any stage and we can talk through your specific circumstances. Wonderful. I think that's it for today. Thank you everyone for joining us and we'll see you at the next one.
Thank you.